All right, good evening, everybody. Thank you very much for everyone that decided to join me tonight. There's a lot of other things that you could be doing, so I really hope that this is worth your time. Just kind of an overview in terms of what's going to happen tonight. Here's our agenda. So when I initially decided that I wanted to do this, this town hall, this meeting discussing what was happening in the markets, that was about a month or so ago, and a lot of stuff has changed in the past month. So we're going to be looking at a lot of new material that I've just put together really in the last day or two. But we're going to talk about the war in Ukraine. We're going to talk about inflation after that. Those are probably the two biggest issues that are on people's minds. Third, we're going to talk about concerns about the banks and liquidity. Then we're going to discuss what's occurred so far in the financial markets this year. And then we're going to open it to Q&A. But what I want to do is I sort of ran through this with my team today. They said, you know, you're throwing a lot of information at people. You've got to give people a little bit of a break here. So after each one of these sessions, I'm going to open it up to some questions. I do want to keep it moving along, but I'm going to open up questions for whatever might be on your mind with some of this information that we cover. On your screens on the bottom, you're going to see a icon there that you can click on that'll enable you to ask a question. I've got it on the right to my side on my other screen here, so please feel free to chime in and ask any questions that you might have. So let's kind of dive right into this. Let's start with the war in Ukraine. Well, this thing has a much bigger impact on the global economy than what just the two economies the size of Ukraine and Russia might have. And there's a couple reasons for that. First, we've got the historical antagonism between NATO and Russia. Second, we've got the energy impacts of this conflict and how that impacts the global economy. Third, agriculture. Not a lot of people are talking about agriculture, but Ukraine and Russia are two agricultural superpowers, to be sure. And lastly, we're going to talk a little bit about how it's impacting global trade and banking. So let's kind of dive right into it. So I want to put Russia and Ukraine into some perspective in terms of how big these economies are relative to the United States. If you looked at the equity markets for Russia, for example, and compared it to Apple, Russia would be number 26. So if you looked at the S&P 500, Apple by far is about 10 times larger in terms of the value of that enterprise versus Russia. So it's number 26. Ukraine's not even in the S&P 500, be out of the S&P 500, be in our mid-cap index, basically. So these are not really huge markets. And even in terms of the overall size of the Russian and Ukrainian economies, California is almost twice as big as Russia. Russia's about the size of the economy of Florida. Ukraine would be somewhere in the middle of the pack in terms of US states. So these are big economies for sure. They're important economies, but they're not economies that are on the order of, say, China or for sure a lot of states in the United States. So why does this matter so much? And for this to matter so much, you got to kind of look at a couple things, because one of the things that the market is trying to price right now is risk. And the fact that Putin has decided to do this right now, I don't think it should be a huge surprise to anyone. For the last 20 years or so, he's been basically saying that he felt the largest geopolitical catastrophe was the fact that the Soviet Empire broke up. And so these light pink countries, if you will, these are all part of the empire, 14 republics. They broke away in the wake of this. And this number 5 here, this is Ukraine. So at one point part of the Soviet Union. Now, this is NATO, and here's why it's important, because we have treaty obligations to defend NATO. And you have these dark blue countries here are NATO prior to 1997. The light blue countries are countries that joined NATO after 1997. I kind of think, as a person that loves history and particularly geopolitical history, buffer states are kind of a really good thing to have between two big powers, and we've lost a lot of those. A lot of them are in NATO now, particularly 3 of the former Soviet republics, Latvia, Lithuania, and Estonia. Now, Ukraine would be right here in the middle. And so we've got, you're sharing a border with Ukraine with a number of different NATO powers. And so the likelihood that things can go sideways and draw us into a larger conflict, that's one of the things. That's why you're getting some of this uncertainty. It's one of the things that the market is trying to price in right now. The other big issue with this, not only just the big geopolitical things that could be occurring, but it is all about energy, and it is all about, we'll start with oil. So the United States, we are really, really fortunate in this country. We're the world's largest oil producer by quite a bit. We can certainly meet our own demand here, but we spend a lot of time thinking about Iran, Kuwait, the UAE, Saudi Arabia, Iraq. The number 2 producer in the world is Russia. So Russia, in terms of being an oil power, is an absolute monster. I think that I'm stealing this quote from somebody, but they said that Putin was essentially a glorified gas station attendant. There's actually a lot of truth to that, but his gas station is massive. It's about 40% of their GDP that comes out of energy. but Russia is a massive, massive oil producer. And oil is one of those things that the elasticity, meaning it's pretty inflexible. People need oil. So you pull a little bit of that capacity out of the market, things get a little bit haywire. The other thing too, if you look at natural gas production, United States, again, we're in a fantastic position. We have a lot of natural gas. We produce a lot of natural gas, enough to meet our own needs. But look at who number two is again, Russia, right up there with us. So everybody thinks of the Saudis, everybody thinks about Iran, everybody thinks about these powers in the Middle East. It's really Russia, when it comes down to oil and gas, is a major power, second only to us. So when you pull their capacity out of the global economy, it makes a big deal. Third is coal, and I'll show you in a second why this is important. China by far is the monster when it comes to coal production. But again, these are the biggest energy producing countries in the world. Russia's right in the pack as well. So why does this matter? For the last 20 years or so, we've been talking about green energy, and we've got Green New Deal and all this other stuff that's going to happen. This here, I love this chart because this is actually what runs the world. The world runs on oil, it runs on coal, it runs on gas. Whether we like it or not, this is what the world economies around the world run on. It's oil, coal, and gas. Almost 84.5% come from those three sources. And by the way, with all the focus we've had on renewables and green energy in the last couple of decades or so, that is only accounted for maybe about 1.5% increase in those green sources. So this is what runs the global economy. Russia is the number two player in oil and gas, and they're pretty big in coal as well. So it has an outsized impact when things go sideways in Russia, because you're taking a lot of this juice, for lack of a better word, off the table. Particularly in Europe. So Europe, we've got a lot of capacity here. We produce a lot of oil, we produce a lot of gas, we produce coal, and we need it. Europe doesn't have as much of that. So you look at, this is essentially the map of Europe here. Here's Ukraine, here's Russia on the other side of it. A lot of their natural gas specifically was flowing through Ukraine. These dark green countries and light green countries are really beholden to that. They need this energy to run their economies. And right now it's a question about whether right now they're not getting any access to it. But this puts everything, this makes everything kind of go sideways when you have this much of a block of countries. The EU is really second to the United States in terms of the economic importance, and they're not getting the energy that they need to run their economies, and they don't have the capacity to get it without Russia right next door to them. So that is why the energy situation is such a problem over there. And that is why, again, the geopolitical stuff, the energy situation is another reason why Russia kind of punches above its weight in terms of global economics. Let's talk about another issue here that I don't see discussed too much on the news. So economies need energy for sure. They also need food. And if you look at Russia and Ukraine, about 25% of all of the trade in global grains is coming from Russia and the Ukraine. The United States, again, we're very blessed in this country. We export a bunch to the world. We can produce as much food as we want, but we are not in a position in this country where we walk into a grocery store and see empty shelves. A lot of other countries depend on staples coming from Russia and Ukraine. That could be an issue, particularly what happens with the planting season, what happens with ongoing sanctions with Russia, what that could do to the world economy, also adding to these inflationary pressures. So before I kind of head into the next section here where we're going to talk about inflation, does anyone have any questions? I just want to take a pause. If anyone has any questions they'd like to ask about what we, okay, yeah, it's a good one. How has the shutdown of the Keystone Pipeline impacted our oil production and its corresponding impact on our economy? I think that I was listening to Psaki say the other day that the Keystone was not an oil field, but I do look at it this way. I think that any of these supply systems, this is not for or against current policy, it just is what it is. Any of these supply systems are very integrated. So although if you destroyed the sink in your bathroom, you'd still have water coming to the bathroom, moving it around, transporting it becomes kind of an issue. So I think, own personal opinion, it's irrelevant to what's happening in the world, but I think we have enormous capacity here. We've got enormous resources. I would personally like to see us use them. So to answer your question, I think it does have an impact because it makes it harder. It makes it harder to move what we've extracted here. Any other questions? It's a great one. Okay. All right, I'm going to dive into the next one, which will probably make everybody not super happy if you've been to the grocery store or the gas station lately. So this is inflation. This is going back to the mid 60s or so. This is the 1970s right here. You had two giant spikes of inflation. Also came around some problems around energy. You had the Yom Kippur War. You had the oil embargoes coming out of the Middle East. You had massive inflation that was coming in here, particularly in the 1980. New Fed Chair Paul Volcker comes in, basically dramatically raises rates, and that got inflation under control for a really long time. For those of us, I have some early memories of the late 70s of actually being in the long gas line in my parents' car at that point. I'm pushing 50 years old, so I do remember some of that. But we've been in this wonderful period of time for a while now where we really haven't had too much inflation to deal with. We even had a little bit of deflation here. This is right around the financial crisis when everything kind of went really haywire at that point. And now all of a sudden we've got this massive spike up. And I want to talk about kind of what some of the reasons are for that and give you sort of a bigger picture of what's happening below the surface. Because you're talking almost 8% here with overall inflation, 6.5% ex food and energy, which again, we talked about that. Everybody needs food and energy. Russia happens to be a big producer of both. So these are really, really big numbers. Now, let's look at this here. Normal inflation, if you want to call it that. It took us about 86 months, say from about 2013 or so into 2020, to have prices raised by about 10.2%. Since the pandemic hit, our prices have gone up 10.2% in the last 21 months. So we basically have had the same level of inflation it took us 86 months to get to. We've done it 4 times faster. So it's absolutely a real phenomenon, and it's one that's impacting everything. This, I think, shows a great picture of what's going on. This is M2 money supply. Basically what it is, it's cash in circulation and it's demand deposits, CDs, that type of thing. It's money that people can readily access and get to. So this is going back to the mid-90s here, and this is growth in the money supply every single year. And you see it tends to pop when there's a crisis. So if you look at this here, this is a dot-com bust. We increased the money supply about 10% to deal with that. It's on a downward trajectory through until we got the financial crisis. Financial crisis was major. You're going to see another chart coming up here in a little bit that shows you how really big it was. But again, we had about 10% spike up to about 10% increase in money supply. Money supply kind of after that, moderate here. We had a few in 2012. We went up again. We increased the money supply by about 10%. This was as a result of European banks being under some stress. Then it kind of petered off a little bit, and then wham, this is the pandemic. So we had, we had the dot-com crash and also 9/11 here. So 2 big things. We had the financial crisis here, and what we did in response to the pandemic really dwarfed all of those things. So we had this massive, massive increase in the money supply, still running above normal, and that's putting a lot of money into the system. So how do we get this money into the system? This is the Federal Reserve's balance sheet, and basically it is this. The Federal Reserve, as we know, they're essentially controlling the currency in this country. And for a long time, it was pretty boring. Their balance sheet was a little less than $1 trillion, and then the financial crisis hits, and they start increasing their balance sheet. Well, here's what that means. If I go on behalf of myself or any clients, and we go and buy some treasury bonds, the net effect to the United States, or the net effect to the money supply is 0. We simply took it out of one pocket and we deployed it for something else. When the Federal Reserve goes and buys securities, whether it's treasuries here, this is MBS's mortgage-backed securities, or other loans that they're involved in now, they do it with money that never existed. So they're essentially printing new dollars, they're putting them in circulation, putting them in the banking system, and they go out into the world to go buy goods and services. Well, we got really aggressive here, obviously, in the wake of the financial crisis, and that continued for a long time, really till 2014. Then the Fed's balance sheet stabilizes, normalizes a little bit, actually starts to go down coming into 2020. The Fed for a long time has talked about wanting to pull some of that excess liquidity out of the economy by reducing their balance sheet. Again, opposite effect. They increase their balance sheet, more money in the system. They reduce their balance sheet, less money in the system. Then COVID hits, wham, they pour money into the system, and then that's essentially that spike in the money supply that you see. So that's happening underneath the surface. Along with this is federal deficit spending. So again, we had surplus back through the 90s. Remember those days? It was good times, good times. But that, federal deficit kind of chugged along there until 2008. It dramatically goes up during the financial crisis. It's gone down a little bit, but stayed elevated since. And then in response to the pandemic, again, not only the Federal Reserve threw every policy tool they had at it, but so did the federal government. So massive deficit spending, essentially financed by the Federal Reserve. They finance that deficit spending by pouring dollars into the system that never existed before. And we're doing all of that during a time period where the supply chain is really stressed because of lockdowns, because of the system being slowed down because of, again, COVID and everything else that was happening. This chart, what you need to know with this is if it's bouncing around this line, supply chain's acting pretty normal. Sometimes there's a little more stress. Sometimes there's a little less stress, but for the most part, things are going along okay. But then all of a sudden we have COVID hit. So you've got major disruptions in the supply chain due to production being shut down, due to stay-at-home orders, due to essentially taking the world economy and putting the brakes on it, coupled with an enormous increase in the amount of dollars in circulation. So it's a scarcity issue, supply chain shutdown, and it's also a monetary issue with just cash being blown into the system. And that's where your inflation for sure right now is coming from. Now, before I kind of go into the next section here, do we have any other questions related to inflation? Any points that anybody wants to dive in a little deeper on? All right, I will then continue here. So global liquidity. Anybody that's known me for a long period of time knows I tend to get nervous when the banks, if there's a liquidity problem, if the banks get stressed. More than a downturn in the economy, I get concerned again if the plumbing of the system starts to show a little bit of stress. So let's take a look at what it's doing right now. So Russia's out of SWIFT. We know that. Is this a good thing or a bad thing? Well, you know, it depends. It's obviously a really powerful economic tool that they've used. But one thing that I want to look at here is the dollar. Here's how massive international trade is really based on the dollar and also to a lesser extent the euro. These are a lot of the different measurements in terms of just shows you the dominance of our currency. International debt, 62% is held in US dollars. International loans, 56%. Foreign exchange, obviously. This global payment currency, this is essentially SWIFT right here. It's dollars and it's euro. And so if you remove Russia out of that system, what you basically have done is you've taken a 1.5 trillion economy and you've just kind of pulled it out of the system. And it also is an economy that's traded a lot of things that people want. We talked about that, oil and gas, agriculture. So you've removed that. So what does this potentially do with the banks? It basically creates some counterparty risk. I got a question here. It says, I saw the Fed raise interest rates today and expects to do more. There's a sharp downturn in the market followed by a recovery above previous levels. Is there an explanation for that? Great question. I'll touch on this in a little bit. So yeah, the Fed raised 25 basis points. The market, you know, if you look at the markets over the last 20 plus years, normally the very first response the markets make to a Fed move is kind of not the right one. It's sort of a whiplash thing. And what you saw today, market was up, kind of weakened a little bit. Federal Reserve came out and said we're raising interest rates by 25 basis points. So the market sell off, and then it rallied into the close and closed at highs. I think the explanation for that is that you know, we've got a little bit of inflation is not a bad thing. A lot of inflation really messes up purchasing decisions. It messes up the ability to make projections in terms of what you're going to do in the future. And eventually, if you have too much inflation, you get demand destruction. You get where people just simply can't pay higher prices, so they don't pay it. And we don't want to see in this economy, we don't want to see demand destruction. So I think that to answer your question, I think the reason we saw a rally with that Fed decision was because there is a recognition that, you know, it's fun while it lasts with a lot of money being blown into the system, but at some point you need some semblance of normalcy. And I will add that prior to what happened with Ukraine and Russia here, the Fed had basically projected they were going to do 6 rate hikes this year. They're still saying that's what they're going to do. They're ending all the QE, so they're not pumping any more cash in the system. And although short term is probably a little bit of a negative, I think in the long term it's a really good thing for the market. So I think the Fed was on the right track. The question is, would they hold their guns? Would they hold the line on that, given that what's happening in Ukraine and some of the other pressures that's now putting on the economy? So I think the market overall today anyway saw that rate hike and said, okay, the Fed's on track to continue doing what they're doing, controlling the currency. Because again, we don't want to base the currency too much for this very reason. We've got an enormous privileged position in the global economy because we own the reserve currency of the planet. If you debase your currency too much, you're going to lose that privilege, and that wouldn't be a great thing for the United States. But essentially, Russia's out of this. Great question, though. Any more questions like that, please fire them over. So are the banks stressed or not? This is something called the TED spread. All this is basically the rate of interbank loans over and above the T-bill. So it's basically, think of this as when this spikes up, the market views banks as being a little bit more risky than what is essentially the risk-free asset, which is the Treasury bill. So to give you an idea where we are, so this is financial crisis, which still, in anything in my career, even COVID, I mean, this was so deep and so profoundly impactful across. I mean, we're still dealing with the repercussions of this. This shows you how much this number blew out. So think, this is uncertainty. This is fear about the banks. This is where we were back in 2008, 2009. Comes in pretty dramatically. We bounce around a little bit. This is banks getting in trouble in Europe a little bit. Some concern about that. I don't know if, you know, the economic history wonks might remember the pig countries and things like that. Then we kind of cruise along here. This is some fear about presidential election rather, excuse me, some of the China tariffs got people worked up a little bit. This is then COVID. So COVID stressed the banking system for sure, but not nearly to the extent that happened in the financial crisis and Great Recession. We still bounce at relatively low levels, but what I care about is the movement. And so this is, again, it's not a huge number. What it's showing is it's meaningful enough to see that all of a sudden there's a little bit of excess risk being attributed to the banks than there was in the past. When this pops, to me, it's worthwhile taking note of that. Another thing I want to look at is credit stress for around the world. Now, China is only one country, but it's a big one. It's an important one. What this chart is basically showing you, when this spikes up, this shows that countries that have issued debt in dollars might be under stress in terms of their ability to repay that. That is also a thing that can potentially stress the banking system, stress the financial markets. Because, and also think of it, it makes sense. If you're an economy around the world and you've got to use your money to do one thing, you got to feed your country, so you got to go out and buy grains. You got to energize your economy, so you need oil and gas. What's going to go first if you want to keep your people happy? You might wait or you might delay what your dollar debt payments are. And so this is essentially saying that there's a concern that could happen to a greater degree. And China's got its own big set of problems as well. But this just shows me none of these are at emergency levels, but it does show that the banks now are under more stress than they have been since March of 2020 when COVID first hit, which is something definitely worth looking at. Before I talk about financial markets in terms of what's going on so far this year, any questions about that? If I see one pop in, I will address it. So let's deal with the elephant in the room here. How have the financial markets done this year? Well, anybody that's opened their statements in January and February, it hasn't been good. And I say that with no degree of happiness. I hate down markets. Absolutely, I despise it, but you got to deal with it. 8 out of 10 years, things work pretty well. There's a couple of years that it doesn't. We're in one of those years. So one of the things I've been hearing a lot about lately is as goes January, February, as goes the start of the year, so goes the rest of the year. And so is there any truth to that? And that's what I want to take a look at now. So this is as of the end of February. Numbers are off a little bit from here now, but we started off down 8% for the S&P 500 through the end of February. So what does that mean for the rest of the year? And the answer is we kind of really don't know. It's one of the worst starts we've ever had, and starts for the year dating back to the earliest one we've got here is 1933. But what does it necessarily mean for the next 10 months? And in some cases, 2009, we were down 18% at the beginning of the year. We rallied 54%. 1933, down 17%, rallied 85%. The only year that really continued to go sideways for a long period of time was 2008. And you can, again, kind of see that in stress in the banking system. Markets started off the year in 2008 down 9.1%, ended the year, and next 10 months were down another 30%. It was absolutely an abysmal year. But most of these years, generally speaking, things did normalize, things did get pretty good. Now, one thing that's kind of unique to what's occurring this year is normally when the stock market is selling off, you've got a place to hide in the bond market. We're seeing rates go up. So that has not been great for the price of bonds. And we've had actually a second worst start to the bond market that we've had in history, going back to 1926. So what does that mean? Well, 1980 was the worst. Bonds fell about 8.8%. Next 10 months, they rallied quite a bit. They're up 12.6%. But past does not necessarily equal the future. But we haven't had experience yet, at least in these in the worst years that we have had for the bond market, where that has continued, and in the next 10 months have not given you a positive level of return. Any questions on that at all? Please feel free to shoot me a question. I'd be happy to talk about that a little bit more. And one thing I like to point to is this, I talk about this sometimes, is normally in December, January, sometime in the beginning of the year, I always get a question that says, hey, Brent, what do you think the stock market's going to do this year, particularly after we've had a couple up years like we had for what ended up in 2020. And then also in 2021, my answer is always the same. It's always, I think we'll pull back at 10 or 15% at some point in the year. And I say that not because I have any huge special insight, but because that's just what the math says. So what you're looking at is this. This is going back to 1980. These dark bars are year-end returns for the S&P 500. And you see that they're kind of all over the place, but generally speaking, pretty good. These red dots on the bottom are the maximum drawdown that you had, meaning from peak to trough in a sell-off overall for the market during this period of time. So year to date, down about 13% year to date. Last year was kind of an outlier. We had a 5% pullback. That was about it. This is COVID down here, down 34%. But what you see, you can go back over several decades, and sell-offs, some of them are pretty painful, tend to be pretty normal. I mean, even in 2009, we ended up 23%. We're down 28% at one point. This one out here I've always thought is interesting. I'm on kind of the lower left here. This is the crash. This is the 1987 stock market crash, where I think the stock market was down about 22% in one day. Peak to trough sell-off is 34%. In 1987, the S&P was still up 2% for the year, which is just kind of interesting. Most people probably wouldn't guess that. So what we're seeing so far is pretty normal. I'm actually kind of surprised that, given, again, the order of magnitude that what happens and what Russia is selling to the world impacts the global economy, and also what we've been through. I'm surprised it's not a little deeper. If I showed you the NASDAQ before yesterday anyway was down about 22%. It's hit those companies a little bit more. But again, what we're experiencing so far, it's happened before, it's happened at other points in history. And another thing, so I don't think that the pressure is done yet in terms of what's happening in the equity markets. And I don't say that to scare anybody, but I just think it's kind of realistic. We've had a couple really good days. It's pretty typical to get some bounces, but a couple things really need to happen. There's a lot of uncertainty for all the reasons I just discussed around what's happening there in Europe. I think it's going to be hard for the market to get out of its way until that gets squared away. We've also got inflation that we have to deal with, and the Fed has a very tight balancing act that they're going to have to try to do here throughout the course of the year. So a question I got last week was, well, if you're in the shorter term a little bit pessimistic, why don't we just sell everything and then wait it out and then just buy stocks back at some point in the future? And here's basically the reason for that. And this is, again, I think this is a great illustration. If you look back, ending in the end of 2021 last year, if you go back the previous 15 years, if you bought $10,000, put it in the S&P 500, it grows to about $45,000. But the stock market doesn't do this. The stock market moves in chunks, and it moves in big chunks. It does nothing for a while, and then it moves in chunks, both up and down. If you miss the 10 best trading days, we're talking about 15 years worth of data. Instead of $45,000, you're up $20,000. If you miss the 30 best trading days, you basically pull 30 trading days out of 15 years of data, you lost money. You put in your $10,000, you're down to 8,300. You actually had this 15-year time period where the S&P 500, the stock market, did some really great things, and you lost money during that period of time. And this is exactly the reason, again, people that are kind of financially a little bit of a geek and a wonk like I am with this stuff. If you recall, if you're the vintage that remembers this, from 1980 to 2000, the number, really from 1980 to 1990 specifically, but one of the best mutual funds was Peter Lynch's Magellan Fund, Fidelity Magellan Fund. It was a great time for the markets overall. He had the best fund in what was a great time for the markets overall. Your average investor in Magellan Fund lost money in the best performing fund during that time period, not because the fund didn't perform, but because when things happened, they sold and they ended up selling. They missed these up days. So instead of making money as the market recovered, participating in those up days, they ended up being like this person right here that had 15, generally speaking, really good years in the stock market and lost money. So this is why we don't try to time the market. Any questions on any of these things that I've just kind of talked about here? If there is, please shoot them over. Another thing I want to point out too is day to day, what everyone's really looking at is stocks. What is the stock market doing? Is Dow up, down? Is S&P up or down? And in the short term, there's a reason for that, because this is stocks, bonds, and a 50-50 mix, just to give you an idea. This is stocks here on the left, this green bar. In the short term, way more volatile than fixed income. In the short term, we've had years where the S&P's been up 47%. We've had years where the S&P's been down 39%. Bond market's been a little less volatile. We've had years where the bond market's been down 8%. We've had years the bond market's been up 43%. Mix of the two is somewhere in between. But what you find with all of these assets, and this is going back to 1950 here. So we've had the 70s, we had the lost decade in the 2000s here in this country. We had some bad investing times here. 5-year rolling period, the worst annualized rate of return you had over 5 years is 3%, negative 3%. Best was positive 28%. You go out to 10%, the worst annualized rate of return you had was down 1%. We actually experienced that in 1999 to 2009. The only other time you've had a negative rate of return over 10 years happened to be during the Great Depression. It was 1929 to 1939. And so these assets, what are perceived as risky assets, they tend to get way less riskier over time, even to the point where if you go out 20 years, stocks are less risky than bonds. Your worst 20-year hold for bonds is a lot worse than actually your worst 20-year hold for stocks. So again, this is one of the reasons that even when things get very uncomfortable, we need to stay in the game. Does this make sense to everybody? Again, short-term volatility, big deal in the stock market. It tends to go away over a longer period of time. This is why that mantra is to hang in there through some of these periods of uncertainty. Another question we've been getting lately as well is international stocks for a long time have underperformed US assets. And the question is, why do we want to own these things? And the answer is because leadership tends to change between these assets. This is a little bit of an outlier here. This is international stocks in the 1980s. What this basically is saying is this: as great as our stock market was in the 1980s, during the middle part of the decade, international stocks beat US stocks by 374%. It's kind of an outlier. This is the time, if you remember, where Japan was going to rule the world and take over the entire world and everything else. But their market went parabolic. It has never recovered since that point. But you have periods of time where international markets outperform. You had several in the 70s. You had a couple of years where international stocks outperformed 80 and 89% versus their US peers. Through the 2000s, 2001 to 2007, international stocks outperformed US assets by 64%. And we are in the longest period of outperformance here, US stocks versus international stocks. Will it change tomorrow? Will it change in 6 months? Hard to say, but at some point that leadership is going to change, and we just want to make sure that we're participating in those asset classes. One of the last points I want to make here, and then open it up to Q&A if anyone has any. How's the consumer doing? You know, we know that the federal government's stressed for sure in terms of the amount of debt that they're issuing, but the consumer actually is in pretty good shape. If you look at the consumer's balance sheet in this country, total consumer assets are about 162 trillion dollars versus liabilities about 18 trillion. Consumer balance sheet is actually really good, and the ability of consumers to pay their debts is extremely high as well. High on this line is bad, down is pretty good. We're better levels than we were back in 1980. Consumer was stressed and leveraged here in the fourth quarter of 2007, but the consumer's ability to pay the debts that they have outstanding right now happens to be pretty good. And again, household net worth continues on an upward trajectory. One other point here, I want to talk about cash briefly. I'm a big fan of having cash on hand to support any emergency needs, and also if you know that you've got a liability, you've got something that you need to be spending money on in 6 months or even a year or so, leave it in cash. If you know you got to pay it, might as well, if you have the money now, leave it in cash. But this is a challenge here in this market for this excess cash, of which there is a lot of right now. You go back before the financial crisis, here's what you're looking at. These blue lines here that run kind of through the middle of the screen, this is the amount of money you would need to be paid on your cash deposits to break even with inflation. So if the bars are above these lines, really good. You can actually hold cash in real terms, actually make some money. And pretty much through 2007, almost every year, you could make money holding cash viewed as a safe asset. This all changed in 2008. Interest rates were essentially put to zero. They've been held there artificially, I think, for a long period of time. So you've lost money by holding cash. And this year, you're really losing money. You need about $6,000 worth of income off your $100,000 to break even in cash, and we are way below that right now. So cash, again, as an emergency fund to pay a known obligation that you have in the future, I am all for it. I believe in having more cash on hand than you think you need. But this is one of the challenges with holding too much of your money in cash in this kind of environment. We'll talk about this too. You know, before Ukraine and Russia happened, actually there was green lights everywhere. Things looked pretty good. The world threw this at us in a way that disrupted this. But this is basically just a heat map. These are major economies. Red, not so hot. Green, everything's looking great. This here is the financial crisis on the far left-hand side. Here around 2020, this is everything associated with COVID. Before Russia, Ukraine, you had obviously green lights across the board. It looked like we were going to have some real outperformance here based on just a pickup in the economies after being essentially artificially shut down like they were for a couple of years. This obviously threw a wrench in that. If this comes to a decent conclusion, then hopefully we'll see those green lights again. Now here's some reason for optimism. I gave you a lot of stuff that might not make anybody too happy to see some of those numbers, but I had a really interesting conversation on Friday night with a gentleman that sells a lot of steel. We're talking tens of thousands of tons of steel. He's a broker, sells to basically every major industrial concern that you can possibly think of here in the United States. And I was kind of lamenting over some of the things that were happening in the world and the economy. And he's about 60 now, so it's not like this is his first rodeo. He's been around the block a few times with different cycles. And he's telling me that he's the most optimistic about the United States and the United States economy than he ever has been. And to which my question is, okay, well, tell me why. I'd love to hear that, but tell me why. And it's basically because of guys like this. He said, if there's one thing that happened, we had COVID hit in 2020. What did that expose? It exposed weaknesses for sure in our supply chain. We've been in a mode for several decades in this country where to save a couple cents, we shipped a lot of stuff overseas that we probably should have been doing here at home. you started to see the turnaround where you started to see things coming back onshore. And now with this that's happening in Russia and Ukraine, we're starting to recognize that in an even bigger way. Taiwan Semiconductor that they're building in the north side of the valley here. This is a massive project. It's going to dump tens of billions of dollars into this local economy here. Well, why is it coming here? Probably because we don't want to be getting every one of our chips from Taiwan. And you're actually seeing in that space, you're seeing a lot of important stuff that's being onshored back in the United States. And so what does that do? Well, for this guy, it means he's got a job. It means that he can go and have McDonald's with his family at night. It means he doesn't have as much of a problem, hopefully, putting fuel in his car. It means this guy is working, and it releases the economic energy and the economic vitality that this country has. I think we've ignored that guy in this country for a really long time. And hopefully we've got two lessons here. We had COVID, and we've also got what's happening over now in Europe. Hopefully these are lessons that the country takes to heart and realizes we've got to do stuff. We've got to make stuff here at home. I can say that, but the guy I spoke with on Friday night, he is seeing it. He's seeing it in a way he's never seen in his entire life. And he's saying he's most optimistic about the economy and the future of this country than he ever has been. And he also brought up something that I thought that was pretty interesting as well. He said, you know, in this country, really since the end of the Cold War, we've been kind of floating out there in the ether, and we think that the world just is what it is, and it's not a dangerous place, and it's all rainbows and unicorns. And sometimes you need that wake-up call to realize that, you know what, it's not necessarily, and you got to kind of pull ranks here at home and worry about getting this guy a job and worrying about your country's interests. And I think that's a real positive. I agree with him on that. I think that's a really positive thing that could potentially happen with this. So now I'm going to open it up to questions, and anything is fair game. I hope you got some value out of that, by the way. We are going to be, we're recording it, so we have a link if you'd like to come back and look at it. So I've got a question here. It says, does the war in Ukraine and Russia, or does the war in Ukraine and Russia drive China close? Sorry, let me start over. Does the war drive Russia and China closer together? The U.S. is a big oil, gas, and grain producer, where European countries buy more from the U.S. and improve the U.S. economy. You know, this is that's a great question, by the way. So you had kind of Russia and China really kind of close, and I think that the Chinese I think China has some really deep systemic problems that we don't talk a lot about here. They've got some really deep problems. As much as we have debt problems and issues, we have demographic problems to a lesser extent than they do. They've got some real big problems. They've been forming this alliance with Russia. They're also chess players, and I think that they were looking and seeing what would happen, what the response would be towards Putin if he went ahead and moved into Ukraine. One of my fears when Afghanistan, when the pullout happened, nature doesn't like a vacuum. I thought we created a big one there. I thought there was questions about the U.S. stomach for some of these things anymore. And I do think that the degree of a unified economic response, I don't agree with it all, by the way, because I don't want to do anything to destabilize the banks, but the degree of a unified economic response towards Russia, I think, has shocked China, quite frankly. And I think they're probably looking right now and looking across the Straits of Taiwan and saying, you know what would the repercussions be to our economy if all of a sudden we had the same level of economic sanctions that have now been taken against Russia? And I think it's probably caused them to put the brakes on some things. In terms of oil, gas, will countries buy more from us? I hope they do, quite frankly. I mean, I think that we've got it. The world needs it. I think we should be the one side. Rather us sell oil and gas and grains to Europe than Russia. Why not? It provides jobs here. It definitely increases our balance of trade as well. So I hope both of those things happen. Another question: how does the shortage of workers across our industries impact our economy, and to what extent does this problem impact optimism for our country? You know, optimism, it's just kind of two questions. Shortage of workers is a real thing. My neighbor owns a bunch of restaurants. He's actually, for the first time, has had to do some shutdowns of his restaurants on a rolling basis because he can't find workers. And that is a real problem. Any business owner will tell you that they can't find workers. I think there's a few reasons, I hope, why this will change. You had, in the wake of COVID 20 into 2021, you had household savings absolutely ballooned, and you had a lot of people that never had any excess liquidity, any excess cash, suddenly found themselves with a lot of extra cash in the bank, because between enhanced unemployment, state unemployment, direct payments that were going out to people, they were making more money when they were working. A lot of that now is being unwound. I think as that continues to be unwound, unfortunately, we have inflation now, but higher prices across the board are going to eat through those savings. I think people are going to have to go back to work. And so I think some of those labor supply issues are going to ease themselves. I also think that, you know, COVID largely anyway has sort of fallen off the conversation as being the main conversation point. And I think in response to this, at least I hope policymakers will sort of realize we've moved past pandemic. We're in endemic stage. You've got to get things rolling again. You've got to stop any of these restrictions that are gumming up the works a little bit. Now that's compounded by the fact that now we've got, China tried this zero COVID policy, and I think they're going to pay dearly for it because they've not allowed this thing to roll in their country, and they're still trying to do zero COVID, and they've shut down two of their major exporting centers in that country right now, which is going to mess them up big time. But I think the labor shortage issue hopefully will solve itself a little bit. In terms of optimism, I'm a big believer if someone's working and they're out there doing something, I think there's more optimism. If they've got money in their pocket, they're more optimistic. So I hope that as those two things begin to follow together, that the optimism also increases. I have one question. The key to worker shortages is immigration. I think it depends on the job. It depends on what kind of job you're trying to fill, for sure. Next question. The millennial generation seems to be rejecting the goals of the baby boomer generation. What the millennials do is going to affect the way baby boomers invest. And are millennials investing the same way as baby boomers do? Millennials aren't really, they're not investing kind of the same way at all. I mean, their share of, if you look at the boomers, there's a really cool, there's a good book, it was written in the late 90s, it's called The Fourth Turning, but there's been a lot of kind of postscripts written on that. But the boomers at this point had amassed far more wealth and far more money than the millennials have. They've got a lot of catching up to do, and they're also bound by, I think, extraordinary amounts of a student debt that's holding them back also. And they're also now trying to get into a housing market that has been large, in many ways been institutionalized with big Wall Street firms that are actually getting in the single family business for the first time in a while. I think it's going to be harder for the millennials, but I do think that as they sort of grow out of single years, I mean, when I was in my 20s, I lived in a very small apartment in New York. Suddenly now I'm married with a couple of kids. I want to have a yard, and I want to have a car, and I want to have these other things that make life if you have a family much easier, and it all costs money. So I think that they will begin to spend money in that capacity, and I hope they begin investing more because they're a giant, massive block that are going to dwarf the boomers in terms of what their spending power is going to be moving forward. Great question though. Hope I answered it good for you. Another question: if Russia and China default on their loan obligations, what happens to the banks and Euro economies? China's a whole nother animal. Let's just look at Russia for a second. There's about $350 billion worth of non-Russian Russian debt that's held outside of that country. To put that into perspective, Evergrande, which was the big Chinese property development company that has basically been missing payments now for a little while, they've got more. So Russia, in terms of, they don't have a ton of outstanding debt, and part of that is because everybody's always been wary of buying Russian debt or any Russian assets, because I think it was 1998 they defaulted on all of their debt. So people, that happens once, and people kind of take a look and say, yeah, do we really want to put some more money there? So I think that it probably would hurt some individual European banks. And then the question is, what's then the secondary risk and the counterparty risk? But I think that very question is why you're seeing that sort of uptick in risk measures in terms of what's going on in the banks. China's a different ballgame. China's a much huger and a massive economy. The positive thing with China is almost a lot of their debt, and we're talking like 90+%, is held internally by that country. So one of the things when Evergrande defaulted, I'm going to turn this. Bear with me here. I'm going to end this share. Okay, there we go, a little better. When Evergrande defaulted, when Lehman Brothers defaulted back in 2007 and 2008, that was about $750 billion back that long ago. So in present dollars, well over $1 trillion. And so, Russian debt is just not that big of a deal. And there's very few holders outside of Europe that are really exposed to that. But it matters because counterparty risk matters. But that's a great question. Any other questions like that? These are all good. I hope that I answered them all for you. All right. If you have any other questions, I'm going to kind of wrap up here. If you have any other questions, please email me separately. Feel free to type them in now. Thank you, everyone, for joining me tonight on this. And I want to add one more thing. Is a lot of the stuff that we're talking about, we don't fill our client inboxes with this stuff, but we have trying to get approval from Raymond James to be able to put this on a YouTube channel, but we're pretty often answering some questions about this kind of stuff. And I want to just point you to something real quick on our website. Stay with me here. Okay. All right, so this is our website here. And if you click on resources, we've got a couple things happening, but if you click on this Ask Brent tab, this is me talking about SWIFT. This is me talking about before they took them out of SWIFT, what happens if Russia invaded Ukraine. I did that before Russia invaded Ukraine. But we're answering a lot of these questions as we're getting some of these questions from people even before they're happening. We want to at least get our thoughts out there. And the positive thing, I guess, is they're preserved for the future, so we can see if we can see how right or wrong we've been. But we're trying to update this every week and a half or so. Another thing that might be kind of interesting is, again, trying to get permission from Raymond James to approve this on normal platforms. But we also just started doing a pretty interesting podcast, and I'll point you to these two: artificial intelligence. David Martin, I won't go into huge detail in terms of who he is, but is really plugged into this AI space. These two are absolutely amazing. When you came in to talk for about 40 minutes, we talked for 2 hours. So we broke it up into two different conversations. But if you have some questions about things that you would like to hear us make some comments about, please let us know. We'll pop it there on the website, and hopefully we'll be approved for Spotify and a YouTube channel soon. We're just waiting on that to happen. Otherwise, any other questions? I've kept you now for about 45 minutes, and I really appreciate that. Any other questions that anyone has about anything going on? Okay. Well, if there's nothing else, then what I'll do is I'll wrap this up now. And I really want to thank everyone for tuning in tonight and listening to this. I think, again, there's a lot happening. There's a lot of ways that things could continue to go sideways here. But there is also, underneath the surface, some really good stuff that's happening. But we're not out of the woods yet. It's going to take some time for all this to work through. But if I have stimulated some questions that you have, please let me know. I'm happy to answer them. And in the meantime, I'm going to hang on here I'll hang on for another 4 minutes or so. And if you're heading to the rest of your evening with your family, again, thank you for joining us. And if you have anything else that you want to ask me, then please let me know. I'll hang on for a couple more minutes. Look, we got a lot of people from some different places around the country here. Thank you. Somebody just texted. Thank you. Appreciate the information. Thank you for tuning in. Appreciate you being here. And good night to everyone. Hopefully you'll go back and enjoy a nice glass of wine and think about something besides Russia and Ukraine and COVID, for that matter. All right. Thanks again. I see people exiting the room now. Thank you again, everybody. I really appreciate it. Oh, wait, we got a question. Great job. Thank you. Thank you. Well done. Appreciate it. Thank you guys for tuning in. Thank you. Thank you as well, Brooke. How do you leverage? All right, here's a question. How do you leverage home equity in this market? I don't know you do, and this is just kind of my personal opinion. A lot of times when things are really great in the markets, I've seen a lot of different cases where people say, take out a home equity loan and put it in the market, because whatever interest rate you're going to pay, you're going to make more than that in stocks. And if you go back over long periods of time, as I showed you, that might be the case. But here's the thing. The liability side never goes down. Okay, so leverage cuts both ways. When asset prices are rising, leverage really works in your favor. Anybody that's made a lot of money in real estate knows that. But when it goes the other way, it goes the other way. It cuts really bad. That's what we saw in 2007, 2009. So I view your home. I've never viewed your personal home that you own as an investment. I view it as best as a very expensive forced savings plan, but it is a way that a lot of people build wealth. And I think the goal should be trying to eliminate debt on your primary house as opposed to leveraging it. Now, if you're investing in real estate as an investment, trying to earn money on it, that's a totally different question. So you should do this more often. Thank you. If this is something everyone's enjoyed, I'd love to do this quarterly. Last one we did was before the election. I love putting these together. So if it's something people would want to do more, I'd love to do it. Okay. How will the market and the economy be affected if the war in Europe escalates? Not good, I don't think, because I think that the EU, the gorilla on the world stage is still the United States, still by far the deepest, most powerful economy in the world by far. If you look at any metrics, it's not even close. I mean, China in many ways is hollow out compared to us in terms of their capacity to do things. There's certain areas that are great. There's a lot of areas that they're not. The EU is also massive and it's deep like ours. If all of a sudden, that's my concern. That's why I brought up the geopolitical risk of things spinning out of control there, because if all of a sudden Article 5 is invoked and now it's not Russia and Ukraine, it's Russia versus the NATO countries and by extension the United States, that overturns the apple cart pretty good for sure. And it depends, like anything, it depends on who wins and what the duration is. It's an answer. I don't have an answer to that one. Another question: do you see the war affecting real estate prices in the U.S.? A couple things with that actually is I think that the real estate, what you're seeing here in the United States, it's really kind of localized. And for example, where we are in Phoenix, and I'm not an expert in real estate, I don't plan on being, but you got a couple things. You got one, location. The second is, what's it cost to buy a house? And there's two things that I think are pretty good right now, at least for Phoenix. If you look at the competitive advantage of Arizona versus Phoenix, Arizona versus Youngstown, Ohio, you can't even compare the two. I mean, should you pay 10 times the amount for real estate here in Phoenix? Probably more than that, quite frankly. I mean, you've got businesses pouring in here. I've always said the Great Recession, the financial crisis, was the greatest thing that could have ever happened to Phoenix, Arizona, because we diversified away from real estate, retail, and tourism into everything else. And we truly do everything else here. Taiwan Semiconductor is one example of that. So I think I'm hugely bullish long-term for Phoenix. I think I'm in the sweet spot of the economic center of the country right now, quite frankly, along with a few other Sunbelt states. So I think that's a positive thing. The other thing, in many cases, you have two things happening in the real estate market. As rates increase, that on top of rising prices is going to impact the affordability of houses, particularly to first-time homeowners and people that haven't had the opportunity to build some equity in their house. The other thing that you have happening is, for the first time ever in the wake of the financial crisis, you're seeing large institutional money pouring into real estate. I think it's Blackstone is buying 1 out of 5 houses in Houston, single-family homes. In the long term, I'm a Wall Street guy. Worked on Wall Street for 10 years plus back in New York, but I don't like that, because I don't want big institutional money turning the country into a bunch of renters. I'd rather have people own their house and have ownership in their home. But what that does do is it fuels the prices. So if you got your house, you're probably in okay shape. So does the war affect real estate prices in the U.S.? That's kind of a roundabout question. I think that real estate, depending on where you are, is probably okay to be. But again, I've always viewed my only real estate holding is the house I live in, and I view it as best as a forced savings plan. That I'm glad I have it. But I don't know if that answers your question. Any other questions? Any other questions? All right. I'll hold for a couple more minutes. Otherwise, we'll until we do this again. But again, if anybody wants to do more of these, I love doing it. I love talking about this stuff and putting this together. So please shoot me an email, or Andy or Kayla or Taylor, and let us know you'd like to see these on a quarterly basis. Happy to do it. And we also, again, we update the website pretty often with some different stuff as well. Any other questions? All right, I think that might be it. I will hang on here for a couple more minutes in case anything else pops in. But otherwise, again, to those of you that are left, we still got a little bit more, about half of our group here. Thank you definitely for spending this part of your evening with me. There's a lot of things you could be doing, but I'm glad that we are being able to talk about some of these things. Okay. All right. Any other questions? If not, speak now or email me, and then I'll answer them then. I'll give it another minute. If we don't get anything, I will sign off. All right, everybody, thank you. And again, thank you for being here. No other questions, so I'm going to go ahead and sign off. But again, really appreciate everybody being here with me tonight. And if this has spurred any other questions that you have or anything you want to discuss deeper, shoot me an email, give me a call myself, a member of my team, and happy to dive into any of these things as much as you would like to. But again, have a wonderful evening and enjoy the night, and look forward to talking to you all soon. Thanks for joining me.